Hey, thought I'd make a video here of the homework for chapter 12 and chapter 13, sort of hit the high spots. So let me go ahead and share that screen if I can, and we'll jump right in. All right, hopefully you can see that. What we have here on this first one is EVA Company has purchased a building, market value $340,000, land with a market value of $40,000, paid $45,000 cash, and signed a 12-year, 18% mortgage. What a high mortgage rate, isn't it, for the balance? So you see that first journal entry, and someone pointed out this wasn't in the PowerPoint, but I think if you look at page 621 through 623 in the ETSU, which is part of your My Accounting Lab, you can read about mortgage payable. Pearson does a great job showing that with the T accounts and the journal entries. So take a look at that if you don't understand what I'm going to go through here. But that first entry there, and this is like if you were to get a loan on your home. Of course, you don't make journal entries, but if you were with a company that purchased property, you would be making journal entries or need to know how to do that. So we put that on our books like you learned in 2010, a debit to building, a debit to land, goes on the books at the value of what you purchased it for, $380,000. Of course, we separate that out because land is not depreciated, but the building is. That's why those are separate. And then we had to put down $45,000 in cash, and the rest of that, the plug number to make this thing balance, debits equal credits, must be $335,000. So you got to make the first entry here on January 31. So they're just making annual payments, which is really highly unlikely. Most of the time it's going to be monthly. But the annual payment, $56.92. Now, where does that come from? All right, well, let's look at the solution. If we take, of course, they don't actually do an amortization table, which you could using present value, or excuse me, payment equal to PMT, payment in Excel. But if we take 335,000, which is the balance in the mortgage payable, times 18%, times one, we are doing the first month. Okay, I'm sorry. The first month, 1/12 is $5,025. So that's the interest expense, right? And they tell us up here what the actual payment is. So that's given. So you're not going to have to, if this problem is on the exam, you would not have to actually calculate using present value tables. If you are an accountant, going to take 30/20, but you're going to have me for that, you would have to know how to calculate this payment of $56.92, but not in 2020. So that's given. So if that's my payment, that's the cash I'm crediting down here in this, down here at the bottom. That's my credit. So then we're trying to figure out, because anytime you have an amortization schedule, you're making the same payment every term, right? Monthly, not annual, monthly. And so the question is, how much is interest? How much is principal? And if you've never gotten a loan, I'm sure you've heard your parents talk about it. When you get a loan, the first few payments is mostly interest and very little principal. But then as you get toward the end, if it's a 15-year loan, most of it's principal and very little interest, because the balance of your payable, your mortgage payable, goes down. And so we calculate the interest expense, $335,000, the payable times 18% times 1/12 says the interest expense is $5,025. And so the payable is only going down by $667. And so you would reduce that. All right. So that's number one. I could talk about that for an hour, mortgage payable, but I think that's the only exercise I've got there. Okay, so here the next one, market interest rate, it says is 8%, issues to bonds with a stated rate of 7.75. So the stated rate says if I sell these bonds, whoever I sell them to expects 7.75% interest. Well, if the market, everybody else is paying 8%, you want my bonds at 7.75% if they have the same risk value based on S&P or Moody's? The answer is no. You will take my bonds if the face value is discounted. You got to write it down, and it's written down based on the present value of the payments and the lump sum at market value. Of course, you don't have to do that here, but just it's a discount. If you're paying a low, if I as a company, and that's what you're doing here, making these, anticipating making a journal entry, If I'm paying less interest than the market, I've got to discount my bonds. The opposite is true. If the market's paying 9, or excuse me, if I'm paying 9%, it's the stated rate, and the market's paying 8.25, then I'm going to sell my bonds at a premium. They're going to be more than face value. If they're the same, they're at face value, there is no discount or premium. Those are the easy ones. And then it says that if the stated interest rate is 8.5, meaning that's what I'm going to pay in interest payments, and the market rate's 10.25, and again, I have to discount my bonds. All right, number 3. I'm going to go through these fast. You can stop and pause and go back and look if you'd like. I've never done these videos before in this online class, but I'm going to now since we're all getting pretty good at using Zoom. So the next one here, 900,000, 8% 10-year bonds, meaning 8% of 900,000 is $72,000, right? Annually. Interest rates are always stated annually, but this is semi-annual, so you divide that 72,000 by 2, right? So it's going to be $36,000 interest expense coming out of cash. And there's our original entry, cash debit. We sold these bonds to bring in $900,000 in cash. And the market rate and the stated rate are the same, so there is no discount or premium. All right, number 4. Here they issue 40,000. Let's see if I can make this bigger. I'll see where I can do that. Anyway, $40,000, 5% 10-year bond at 110. What's 110? That's an interest. That's a factor. 1.1 is what it's saying. So 1.1 times 40,000 is going to be the cash I receive. So that tells you it's going to be a premium, right? So I'm going to receive 1.1 times 40,000 is 44,000. Bonds payable is always face value. It doesn't matter if it's a discount, a premium, or a stated rate, same as market rate. It's always at face value. And then the plug number, the difference is my premium or discount. In this case, since it has to be a credit and the fact that it's 1.1, which is 10% higher than face value, tells you that you're selling these bonds at a premium because your interest rate's higher than the market. All right, so then what do we do with that premium on bonds payable? We have to amortize it over its life, and we do that through straight line. We just divide it by the number of terms and then plug that in. Interest expense, excuse me, it's going to be the difference. Interest expense is going to be the plug number because we know what the cash is, right? The cash we're paying out is going to be 5% of 40,000, again, annually. That's $2,000 divided every 6 months divided by 2 is $1,000. So $1,000, we know that if these are 10-year bonds, twice a year, 10 times 2 is 20 terms. So 20 into this 4,000, right? We're going to amortize that 4,000 over 20 terms. 4,000 divided by 20 is what? 800. Or excuse me, 200. I said that right? 4,000 divided by 20. Yeah. I was never good at math, right? That's why I'm accountant. 4,000 divided by 20 is $200. All right. And so if that's 200, that's 1,000, then interest expense, you can't calculate that. Interest expense is the plug number, is $800. Because you know what your payment is. That's what people expect. They're expecting 5% every year divided by 2. That's what they expect. We know what the amortization is, so the interest expense is a plug number. Remember that. Makes it easy if you know what to plug. All right, number 5. Here again is 125,000, 7% bond. Issuance of the bond at face value. So there is no discount. It doesn't say anything about what the market rate is, does it? So cash, bonds payable, then interest expense. It's going to be 7% of 125,000 divided by 2 is 43.75. All right. Number 6. Let's see here. Following transactions. Let me click on that. Purchase equipment. I'll have to slide this up so I can see it. My battery's getting low. Purchase equipment costing $120,000, issuing 10-year 5% note payable. All right, so we're not getting cash in this case. We're financing our business by getting a loan for this equipment. So we put the equipment on our books. We get the equipment, put it on our books. Notes payable is $120,000. Then the interest is 5% of $120,000. And we're doing this on June 1 of each year. So when did this start? June 1. So we've got June through December. What is that? 7 months. So we got 7 months. So 7 divided by 12. If I click on the solution here, it'll be easier to see. 120,000 times 5% times 7/12. We got to make that accrual at the end of the year. You learned all about accruals in 2010, that the accrual basis of accounting requires that it doesn't matter when you make the payment or receive a payment, you record the interest expense when it's actually been incurred. So you got 7/12, $3,500. It's going to be interest expense and a credit to interest payable. And that interest payable is going to sit there until 5 more months. 7 plus 5 is equal to 12, and you're going to make that payment there on May 31st or June 1st. All right, so what does that look like down here? June 1. There's my $3,500 interest payable. That's, I'm zeroing out that interest payable is on my books since December 31 on my balance sheet, right? Got to get that off my books. There's the additional 5 months of interest expense. Either $2,500 and the $3,500 is $6,000. 5% of $120,000 is $6,000 for the year. All right. We're going to make a payment of $12,000 each year. So my note payable is going to go down by $12,000. See, that's a little bit different what we do with bonds payable. Bonds payable just sits there until the very end, till maturity, unless you retired early. And so there's the reduction of note payable to $12,000. And there's my total cash. $12,000, the note being paid off, $6,000 in interest. And so the next year, that $120,000 is now has a balance of $108,000, doesn't it? Remember that up here in the solution? So the next year, we've got $108,000 sitting there that we're going to do the accrual on. So right there, December 31, 2019, 7 months, just like we did the prior year on $120,000, but now it's $108,000. So the interest has gone down, hasn't it? $3,150. It's a little bit different than a mortgage payable. Mortgage payable is the same rate. It's the same payment every time. But with a note payable here, the note payable, the value or the dollars that you're paying back changes, as well as the interest. All right, so we go down here to the last entry for December 31, and there's my interest payable for those 7 months. All right, and then it says down here, what's the total liabilities at the end of the year? Well, you got $111,150. That's the $3,150 interest payable on your balance sheet, and the other $108,000 is your note payable. So you got a note payable, long term, and then you got this interest payable, which is actually short term. Of course, this whole chapter is about long term liabilities, but here's a case where you got a current liability or short term liability as well. All right, so that's practice set 1. Let me go ahead and jump over here to practice set 2. I'm going fast, but you can screen sharing has stopped. Okay. And my head is sinking down to the bottom of the screen. Let's see, practice set 2. new share. Let me see if I can share. Hopefully what you've been able to see so far is good. All right, so here's practice set 2. What we got going on here? All right, looks like we're given selected information here. And all we have to do here is just plug it into our balance sheet, right? Balance sheet, you got income statement, balance sheet. Balance sheet is for a point in time. Income statement is for a period of time. The only thing the same between a balance sheet and income statement. Income statement has your revenue and expenses are closed out to retained earnings, which is closed out to, closed out to income statement, which is closed out to retained earnings. So retained earnings is the only thing that links the two. But anyway, here they just want you to plug in your current liabilities, which is, again, you can read it there, accounts payable, salaries payable. Current liabilities are anything you're going to pay within the next 12 months, or operating cycle, which is 12 months. Long-term liabilities, anything you're going to pay beyond 12 months. And yes, there's a portion of your long-term that's going to be current, like a note payable, for example. If you're going to pay off a long-term note payable, some portion of that in the next 12 months, you got to move part of that to current. So again, you can see the solution. I don't have to belabor the point here. Pretty straightforward. Number 2, calculating a ratio here. This is what the debt to equity, assets equals liabilities plus equity. Assets equals liabilities, the same thing as debt. Debt, liabilities the same. So liabilities divided by equity, 17.5 divided by 14, 1.25. All right. Number 3, excuse me. Williams Company is planning to issue $530,000 of 10% 15-year bonds payable for major expansion. Advice, what's the requirements? And that's the same thing as what's written here. So I'll just, what type of bond will have the total interest expense equal to the cash interest payments, face value? Which type of bond will Williams' total interest expense be greater than the cash interest payments? Discount. You can read those for yourself. What's the price of $530,000 bond issued at 86? Again, that's just assume there's a decimal in there. 2 places to the left, a decimal. So if you got 110, 2 decimals over is 1.1 times face rate. 2 decimal places over from 86 is 0.86. So you know it's going to be a discount. So 0.86 times 530,000. There you see it. 455,800. All right. How much would Williams pay in interest each year? $530,000 bonds, 86, $53,000 in interest. That's 530,000 times 10% times 10% is the cash pay, but the interest expense, again, is your plug number. Don't forget that, it's your plug number. So 530,000 minus 455.8 divided by 15 plus 53,000, 57,947 for the year. All right, excuse me. If you have to make a journal entry to understand this, go ahead and do it. I mean, that's what I would do. And I was controller for many years. So doing a T account, making journal entries always works. So you can see what you're debiting, what you're crediting, right? Follow through instead of just making this a math problem. All right, number 4. Here we've got Worldview Magazine, issue 690,000, 15-year, 9% callable. Callable means they can call these bonds in as the issuing company. Why would you want to call them in? Interest rates decline. You don't want to keep paying a higher interest rate if the rates have gone down. So these were callable at 96. And they called the bond, they issued the bonds at 96. They issued them at a discount, but they're callable at 103, meaning it's kind of like a sweetener. They're going to pay more to get, it's probably in the contract or the bond, it's probably in the debenture that they're going to have to pay extra cash to get folks to turn them in, or they may not have bought them to begin with if they were callable. So they're going to give them a sweetener there of 1.03 times the face value. So what does that look like? If these bonds are carrying amount of the bonds payable July 31, 2021. And so this is 1 year into it. So you got 1 year of amortization that you have to figure out. All right, well, how do we do that? I don't have a scratch pad here like I would have it in my office. So let's just look at the solution, show how this works. All right, so the amortization and the carrying amount is $662,000. They don't have you do the actual journal entry for issuing the bonds. Nothing wrong with doing that if that's the way you understand it. In fact, I would encourage you to do that. But to face value 690, they're issued at 96. So 96 times 690 is 662,400, leaving a discount of 27,600. So you're thinking debit to cash. And I don't have the ability to write that on here. Debit to cash for 662.4, debit to discount for 27.6, right? Debit to discount, and credit to bonds payable for 690. So that's the original entry you would have made. Then you're multiplying the carrying value, which is 662.4, right there it is, carrying amount, times well, no, you don't. Under the effective rate of interest method, all you have to do is the discount is going to be 27,600 divided by, these are 15-year annual interest payments. So that 15-year, 15 into 1840, or excuse me, 15 into 27.6, there it is. 27,600 divided by 15 is 1840 amortized per year. All right, that gives you how much the discount, and so the plug number is going to be the interest expense, right? All right, so the discount 27.6, and of course we don't have to make that journal entry, but we are how far into this? We are this is annual. 3 times 1840. Oh, they were issued in 2018. Okay, it is 3. Okay, now I'll see why. It is 3 years. 3 years in. So from July 31 of 2018 to July 31, 2021, 3 years. So you got 3 years of the discount being amortized. So that tells you that the discount on bonds payable is now much less, isn't it? It's $22,080. All right. And so there's my discount being written off, a credit, because it has a debit balance. Discount has debit balances, premium have credit balances. So I'm getting rid of my balance sheet accounts. Discount on bonds payable. My bonds payable is coming off my books, so I got to zero that out. My cash, because I'm paying 1.03 times 690, so 1.03 times 690, is that on here somewhere? There it is. Market price paid to retire bonds, 690 times 1.03, 710.7. So my plug number is my loss on retirement of bonds payable. That's a plug. You can't calculate that other than that's the last item, last line item that you're putting in to make this thing balance. So it's a loss. Since it's a debit, it's a loss. If you had to make a credit entry, then it would be a gain on this retirement. But it's a loss because you are paying 3% higher than face value for these bonds. And you normally would have paid just the face value. All right, so that's good exercise to walk through. Hey, I can't work these through T accounts in class or through a scratch pad, but I don't have that on my computer here at home. All right, and then here's, excuse me. Here is market rate of interest 5%. ECU issues as bonds. Bonds be priced at face value at a premium or discount. That same stuff's over here in this, so I don't need to leave that. So that's a premium, right? They're attractive. Investors have to pay more than face value. All right, market rate's 9%. And these are 6% bonds issued. That'll be a discount. Nobody wants your 6% bonds if the market's paying 9%. So you got a discount. They're going to be less than face value. All right, and then it says these bonds were sold at 97. That tells you if it's less than 100, then it's a discount. So there's the cash, 97 of 1,970,000. There's my bonds payable is always at face value, and the difference is my discount. There's my interest expense, right? 6% times 100,000, or excuse me, times a million is 60,000 per year, but this is semi-annual. So that's 30,000 going out the door in cash. There's my discount. 20-year bonds, twice a year, that's 40. So $30,000 divided by 40 is 750. And so my interest expense is my plug number. There it is for the next year. See, those don't change. I almost started to talk about an effective rate of interest method of amortization, but you don't have to worry about that in this. You will get that in 30/20 if you decide to be an accounting major and potentially a minor. And then at the end of the 20 years, there's the reduction of bonds payable to zero, and I've got to pay the cash back. People want their interest payment and the cash. All right, let me click on the solution here if you think that helps. There it is. You want to freeze on that and take a look at it later, but I'm going to keep moving. All right, so that's practice set 2 for chapter 12. All right, let's keep going. Let's see if I can, oh, there's self-assessment. Forgot about that. Let me see what's in there. Two exercises. Let's see, I got 23% left on my battery. 5% 10-year bonds at 80. You probably got the hang of this by now. Self-assessment is kind of just checking to see if you know what you're doing in this chapter. Maturity value of the bonds, 100,000. Carrying value of the bonds at December 31, 2020. There it is. They give you that information, 84,000. There's my discount. You know, it's interesting because when you look at this 80% of face value, so originally it was what, $80,000? Yeah, when they were issued, but now it's up to 84,000. So what's going on there? This is just sort of a teachable moment. You know, as you amortize a discount away, the value of your bonds are going up. You know, you got bonds payable sitting there at 100,000, and you've got this $20,000 bonds payable that offset. And when you combine those two together as carrying value, your carrying value was 80,000 when these bonds were sold. But as you amortize this discount away, the discount gets smaller, doesn't it? It's going to go from 20,000 all the way down to zero. So the only thing that's left is going to be that 100,000. And so you can see here after 2 years, that's what this data table, that's what this looks like, December 31, 2020. So that 20,000 down to 16 because they've amortized 2 years of that 10 years. So 20% of that 20,000 is gone, right? That's what that 4,000 increase is. All right, I just thought I'd throw that out there if you're wondering what that is. Semi-annual interest cash payments on the bonds, 5% of 100,000 is 5,000 a year. So twice a year is 2,500. Interest expense each year. So right there's the journal entry. There's my cash payment every 6 months. There's my discount every 6 months, right? 2,000 a year. 4,000 after 2 years, right? All right, now leaves you your interest expense. And again, interest expense is your plug number. That's one of the keys in accounting. You got to know what the plug number is. Don't sit there and grind your wheels trying to think, how do I calculate interest expense? Well, you don't, other than if I know what my cash payment is and I know what my amortization is, then that's the difference. Because this thing has to, debits must equal credits. All right. And then the last one for chapter 12, 9% 20-year bonds, face value 400,000. Bonds were issued at 107, so 1.07 times 400,000 is 428. Right? That tells you it's a premium, and a premium is always on the same side because a premium is a liability account. Discount is a liability account, but a discount is a contra account. Premium is an adjunct account. It increases the value of your liability. 428, you know, just like discounts going away and the value of your bonds payable goes up, this is the opposite. You're sitting there with a liability of 428,000. As that 28,000 is written off, then what? That 428,000 becomes 400,000 at maturity. Opposite direction. And you notice that on the interest expense, premium on bonds payable as well. Interest expense is your plug number. Cash is always the stated value. 9% times 400,000 is 36,000 a year, 18,000 every 6 months. All right, what else is down here? And to show the payment for a second 6 months, and then the final pay back the principal, right? All right. So that is chapter 12. Do I have enough time to do chapter 13? We'll go ahead and start, and then I can pause it. So let me go find that. Chapter, I'm not going to do the pre-lectures. Those are pretty straightforward. You probably ignore those anyway. All right, I think that's sharing. All right, practice set 1. Now, chapter 12 was about long-term liabilities. It's how you fund your corporation, either through long-term notes payable, through a mortgage payable, through bonds payable. You know, we hit a lot on bonds payable, but you're selling something or getting a loan in order to fund your corporation through debt, through liability. Now we're going to look at funding your corporation through selling stock, whether it's common stock or preferred stock. And also this chapter is about retained earnings, which is what happens when you close out revenues and expenses to income summary. Now those are temporary accounts on your income statement. Those are closed out to retained earnings because the balance sheet are permanent accounts. Assets, liabilities, and equity never get zeroed out like revenues and expenses, unless you depreciate something fully. But when you depreciate something, that's through your accumulated depreciation. You don't impact your actual asset account unless you actually sell it. So here you can read this. I don't think I need to go through this part. So let me keep going. Number 2, let me go back to number 1. It looks like there's something down here at the bottom. There it is, requirement 2. Talk about advantages and disadvantages of a corporation. You can do that on your own. You don't need me to talk about it. That's why you're in a long line class, right? So we issued stock, and I think this chapter is probably a little easier than what you did in chapter 12. Chapter 12 is always a tough one for most people. It's a shame you have to start out in 2020 with that, but that's just the way it is. 2020 is typically harder than 2010. So there we have, we're selling stock, 4,500 shares of common at 11. So that's how much cash we're bringing in. 4,500 times 11 is 49,500. You always make the entry for common stock at par. So 4,500 shares at $5 par value gives you 22,500. Paid in capital is always the plug number, right? You hear me say it a lot, plug number. And there's the worked solution for that. So you can see that as well. All right, and then the preferred stock was total value 67.5, so it was sold at par, it looks like, right? Because there's no additional paid in capital. All right, so that's number 2. Number 3, earn net income 105,000 during the year. declared a cash dividend on 3% of preferred stock. You know, preferred stock dividends are always based on par value. And so they tell you the par value here. So 3% on par value, 3% on 135,000 is $4,050. And then we have a $10 per share. My face is in the way here. Let me move it. Dollar per share cash dividend on its common. Common is usually stated at how much per share is the dividend for common. So there's 65,000, and both those are dividends payable, preferred, and common. Cash dividends, you think, what kind of an account is that? Used to use retained earnings for that. Cash dividends is just another way to isolate retained earnings. So that is an equity account. You are reducing retained earnings when you put cash dividends there. All right, I like retained earnings, but this is what we're given to use, and this is what you should use. All right, and then that was on December 15th. They declared it, board of directors, that's when the liability is set up. That's why it's a payable, a liability, you're obligated at that point. Then they actually pay it out on January 4th, so this dividends payable are zeroed out and it comes out of cash. Very simple. All right, number 4. This is a stock dividend. You know, if a company doesn't have the cash, but they've got the retained earnings, they oftentimes will issue more stock to people. All right, so what's happening there in general, you are reducing retained earnings by an amount, and you're going to put it into common stock. So you're really just capitalizing retained earnings. One of your retained earnings or one of your equity accounts goes down, which is retained earnings, another equity account goes up. There is no dividend payable because this is an issuance of stock. There's no cash involved. So what does that look like? Well, here they got stock dividends, which is another word for reduced retained earnings for $544,000. And in this case, it says here that they're 340,000 shares, they declared a 40% stock dividend. Well, if you remember from the PowerPoint, there's a threshold somewhere between 20 and 25%. If the stock dividend is above 20 to 25%, it is a large stock dividend and you use par value. All right. If the dividend is less than 20 to 25%, like 10%, then you use market value of the stock. That's the only thing that's different. And so here, this is a large stock dividend. So we're going to multiply this 40% stock dividend times 340,000 shares that are outstanding. That's what's important, outstanding, not authorized or issued. What's outstanding? Outstanding times 40% gives you a dollar amount times the par value, which is $4. So let me just show you that. $4 per share, right? That's par value, so because it's a large dividend, times 340,000 shares times 40%. So there's my dollar value. I'm going to reduce retained earnings by $544,000, and I'm going to put it where? In this account called common stock dividend distributable. That's another equity account. That's when it's declared. Then when it's actually distributed, not paid, it's distributed, meaning people get their extra shares of stock. You're going to zero out that common stock dividend distributable, similar to what you did with dividends payable on a cash dividend, and it's going to get thrown all in its entirety to common stock at par. There's no additional paid in the capital because it's at par, right? All right, so part 2 says, what is part 2? Well, part 2 says how many shares of common stock are outstanding after the dividend? 476,000. So that's your what? 340,000 plus 40% of 340,000, whatever that is. So 1.40 times 340,000 is 476. If this problem had been about, instead of 40%, if this had been 10%, what would have been different is you would have used the market share of the stock to do the calculation. I'm not sure if we have one here like that or not, but that's what you would have done. All right, here's stock issuance again. What's this say? We issued 1,900 shares, $1 par. For cash, 1350. Simple problem there. I don't even need to talk about that. You can work through that. You see the solution, pretty straightforward. Number 6. All right, what happens with a cash dividend, a stock dividend, or a stock split? I haven't talked about stock split, but you've read about that in the PowerPoint. Cash dividend, stock dividend, both reduce retained earnings, even though they don't use the title retained earnings, which they should. Both reduce retained earnings. Cash dividend, yes, it's going to impact dividends payable, but then dividends payable is going to be zeroed out, isn't it? So it has no impact on dividends payable after it's paid. There's no impact at all in a liability for a stock dividend. Increases paid-in capital by the same amount that it decreases retained earnings, yes. But the paid-in capital in excess of par, if it was a small dividend, yes. But if it's a large dividend, there is no additional paid-in capital. All right, and then decreases both total assets and total stockholders' equity, yes, because what? Retained earnings goes down and cash goes down for cash dividend. It's no impact on assets. Again, a stock dividend, one equity account goes down, retained earnings, common shares, and additional paid-in capital potentially. If it's a small dividend, small stock dividend, yes. No effect on total stockholders' equity, right. It does have an effect on stockholders' equity. Cash dividend, retained earnings goes down and stays down. Stock dividends, retained earnings goes down, but common stock goes up for the same value and additional paid-in capital. All right, what's this stock split thing? Stock split is when a company wants to, first of all, you don't have to make a journal entry. For all of you who hate making journal entries. A stock split, let me give you an example. Netflix was trading at $700 a share several years ago. At $700 a share, Netflix said, well, we're going to have a 7-for-1 stock split. So what does that mean? Well, the market closes at 4 o'clock, and if the stock was selling for $700 a share, the next morning that stock starts selling for or trading for $100 a share. Because if you had one share at 4 o'clock the day before at $700, the next morning instead of one share, you got 7 shares of stock at $1 at $100 a share. So it has no impact on your wealth. It has no impact on your financial reporting. The only thing that changes is the par value changes and shares outstanding, but it has no impact as far as dollar-wise. So why do companies do it? Well, it's really a marketing ploy, in my opinion. It's something that companies do that say, well, how many people can buy Netflix at $700? But if we do a 7-for-1 down to 100, first of all, people are going to say, man, that stock split 7-for-1. Maybe it's going back to 700. I'm going to get 7-fold on my money. Maybe eventually it will. I'm not sure what Netflix is selling for now. It's not back to 700, but it is pretty daggone high, a lot higher than $100. But the optics of it is part of it. But the other part of it is they're saying, well, somebody might be able to buy it at $100 a share. This is your typical retail investor, but they can't buy it at 700. So they may increase the demand for the stock, which is what they want. So anyway, I just thought I'd throw that in there, what stock splits are. You've read about that in the PowerPoint. Keep an eye on my battery there because I think it's getting pretty low. May have to pause and plug this thing in. 12%. All right, the last exercise here in practice at 1 of chapter 13. What kind of stock? And this is looking at a balance sheet. Obviously, they have preferred stock and common stock. $5 per share is the par value. Make 2 summary journal entries to record issues of the stock. That must be in the requirements, maybe. Make 2 summary journal entries. Where is that coming from? I guess they're just wanting you to show what these journal entries would have been for this for some reason. All right. And the common stock, That's what the journal entries would have looked like. And once it's posted to your ledger, general journal, posted to your ledger. Now they're talking about doing a cash dividend, 400,000. Preferred stock, if it's preferred, means preferred shareholders, they get their dividend first. 5% of par value must be $80,000. And say what the par value is. But there's no additional paid in capital, so that is par value. So 5% of 1.6 million, since there's no additional paid in capital, 5% of 1.6 million is 80,000. There's my dividends payable. The difference, 400,000 minus 80,000 is 320 because common shareholders get their dollars last. And so there's my total 400,000 that the corporation decided to distribute in a dividend. And there's the actual payment. The cash dividends is retained earnings. I wish they would change that, but they don't. Cash dividends is retained earnings. Dividends payable, those are liabilities. So zero out the liabilities and take it out of cash. All right, so there's practice at 1. Now I'm getting a warning about my battery. So let me pause this. I think I can pause it somewhere up here. All right, got my battery plugged in. So let's see if we can go through practice set 2 and then the self-assessment. All right, so this one is about treasury stock. You know, I talked a little bit about, of course, this is all in the PowerPoint, but you've got 3 things when you start talking about shares of common stock. You got authorized, which might be, let's say, 1 million shares. You've got issued, which let's say is 500,000. And then let's say you got outstanding is 400,000. Well, outstanding is what's used to calculate earnings per share. It's what's used in calculating your dividends. So what's the difference between that 500,000 issued and that 400,000 outstanding? And the answer is this exercise here is treasury stock. A company decides that they want to buy back their stock either as an investment or for stock options or whatever it might be. They, in essence, are taking these common shares out of circulation. You don't pay any dividends on treasury stock that a company owns. And it also, you can tell it's taking more shares out. So you can have your earnings per share go up for no other reason you bought back your own company stock, right? It's a way to manage earnings. And so when you see treasury stock, usually it's talked about on TV as corporate buybacks, but it's treasury stock and what these textbooks call it. So let's look at this first one. And it shows you what your stockholders' equity looks like. Common stock at par, there's your 1,300 shares authorized, 130 shares issued and outstanding, meaning they don't have any treasury stock. If issued and outstanding are the same. There's my paid-in capital, retained earnings, stockholders' equity. All right, so what happens? We have a December 30th, Frontier purchased 100 shares of treasury stock at $8. So they actually, their treasury department has to actually pony up $8 because that's the market value. Pony up $8 a share. So they got to spend $800 to buy back these shares. So you credit cash because it's coming out of your cash account, and you debit this contra equity account called treasury stock. It offsets equity. It's a reduction of equity, right? Okay, so there's the first entry. And then they just want you to show, it looks like the stockholders' equity layout at the end of the year. So there's my 1,300 shares authorized, 130 shares issued, nothing changed there, but only 30 shares outstanding. Remember, they purchased 100 of their shares back. Then down here, below retained earnings, I don't know why they put it there, but they always do. Treasury stock, common, 100 shares at cost. There's the $100 negative. And that's a negative because it has a debit balance. All these others have credit balances, right? Yes, equity always has a credit balance. Liabilities always have a credit balance. Assets, debit balance. Now, retained earnings could have a debit balance, right? If you lose enough money, you could have a debit balance there, but not in common stock or paid-in capital. But you do have a debit balance in treasury stock, always. All right, that's pretty straightforward. Let's look at number 2. Here we're, again, I've talked about this chapter being about stockholders' equity, issuing stock, whether it's common or preferred, but it's also about retained earnings. And what happens if you have a prior period adjustment, meaning if revenues and expenses get closed out because they're temporary accounts to retain earnings, and then you find that you have an error in a prior year, well, you have to make a prior period adjustment against retained earnings because you can't do it against revenues and expenses for that period. That's already been closed out through income summary. So you do what's called a PPA, prior period adjustment, to retain earnings. And they just want you here not to make the journal entry, just to show your statement of retained earnings. So there's retained earnings, 44,000, originally reported. There's my prior period adjustment for $8,000 because it says net income of prior years was overstated, an accounting error. If it's an error, you have to make a prior period adjustment. $8,000, so there's my reduction. So my retained earnings adjusted prior to this year should have been $36,000. And so what happens in the current year? Well, only 2 things happen to retain earnings. You've got net income or loss, and you've got the payout of dividends or distribution of a stock dividend. So it's either dividends or income or loss. So there's my net income added to that, and there's my dividends declared, which is a reduction. Doesn't mean it hasn't been paid yet. It's just reduced my retained earnings. So there's my retained earnings for December 31, 2018. All right, number 3. It's like some ratios here. Compute earnings per share. Well, net income minus preferred dividends. Why are you subtracting preferred dividends here? Because it's based on common shares outstanding. So if you're dividing net income by common shares outstanding, you want to subtract out any preferred dividends, right? Preferred dividends are after taxes. Net income, right? That says you've already taken taxes out. So preferred dividends are after taxes. So 124,950 minus 1650, and that's up here at the top. 124,950 is my net income. You won't find net income on your stockholders' equity. Preferred dividends, 3%, 55,000. 3% of 55,000 is 1650 divided by 54,800. So they're saying that's the average shares outstanding for the year. Earnings per share. All right, and then the second part here says, assuming a market price share of $9, what's the price earnings ratio? Well, whatever your earnings per share is going to be the denominator. And so you're going to take the market share of the stock divided by the denominator and gives you a PE ratio. Now, the average PE ratio currently is about 25 or 26 for the S&P 500. Some companies like a Netflix might be 200 because trending upward as far as earnings. Facebook, Google, usually your technology companies have a higher PE ratio. Then you look at companies like General Motors or Ford, your old stodgy, slow, really not progressing. They're not growth companies. They're just kind of, they're there. They're going to have very low PE ratios, like a 4 or a 5 or a 6. I don't know anybody's got a 4, but it's very low because they just don't anticipate growth. So all of this is relative to do comparisons that finance people take this and compare to their industry peers. All right, then number 4, another one here. Here we have, what is the rate of return on common stockholders' equity? Return on equity, for short. The numerator is the same. It's net income minus preferred dividends, and then it's divided by the average common shareholders' equity. So what is average common shareholders' equity? It's everything but preferred stock. That's the easy way to remember. It's everything but preferred stock. So what do? And here the average says, well, these are balance sheets, right? 2017, well, the bottom part is 2017, 2018. These are the balances. So if I've got preferred stock, I'm going to ignore that. So what I want to do, I'm going to take 179,000 plus 7,000 plus 169 plus 2, add those 4 up, and divide by 2 is going to give me this 178,500. Right? 179 plus 7 plus 2 plus 169 divided by 2. It's not the total stockholders' equity. You got to leave preferred out. Let me show you the solution up here. Well, they do a little bit different. They like to take the total and then subtract it out, right? They're taking 173 minus 2 and 188 minus 2 divided by 2. You can do it that way too if you want to. So the answer is 178.5. 10% return. You see, you got dollars divided by dollars, don't you? That's got to give you a percent. Dollars by dollars is a percent. That previous problem, dollars divided by shares, dollars divided by units, that's dollars, earnings per share. And then PE ratio or PE multiple was dollars divided by dollars. Market price of the stock divided by earnings per share. Dollars divided by dollars gave you a multiple. All right, then number 5. Now we got more here, don't we? Ratios. Any new ones? Net income minus preferred dividends, average common shares outstanding. So in this case, they probably want you to do a calculation for shares outstanding. Common shares, 10,000 shares issued and outstanding. Well, it didn't change, did it? It's the same between last year and this year. All right, $39 divided by 30 cents. There's my PE ratio. Sounds like a tech company, doesn't it? 30. Again, S&P 500 is about 25 or 26, which is historically very high. All right, and number 3, Return on common stockholders' equity, again, 5,000 minus the 2,000. It's the same as earnings per share divided by average common shareholders, stockholders' equity. So what do we do there? All right, you can, if you want to follow what the book's got, 120,000 minus 40,000 plus 121 minus 40 divided by 2 will give you 82,500, which says you got a 4% return on your common shareholders' equity. And there's the solution that shows you that. Oops. All right. So that's practice set 2. And now, I've got one here called treasury stock. I added that one. Let's look at it. Let me see if that is sharing. All right. Oh, this is one that I added because we didn't have one set up that shows the actual sale of treasury stock. You know, we invested in treasury stock as a company, either for stock options or just as an investment. But what about if you sell that? Because some companies do that. So the treasury stock transaction says they purchase 1,600 shares of the company's dollar par value common. Don't care about par, that's irrelevant. You paid $7 a share. So 7 times 1,600, debit treasury stock, credit cash. Then we sold 500 shares, right? What did we sell it for? $10. So we sold it as a profit, didn't we? So 10 times 500 is my cash I received. So there's my 5,000 debit to cash. Treasury stock has to come out how it went in. Well, it went in at 7, didn't it? Right? So it's got to come out at 7. So 7 times 500 is 3,500. It's coming out of my treasury stock. And the difference is kind of a gain, right? But we don't report it as a gain to the income statement. We create this account called paid in capital from treasury stock transactions, which is telling you you've got a gain booked and it's sitting there in your equity account, not on your income statement. That's what's unique about it. All right, then it says they sold 800 shares of treasury stock for $3. So that's at a loss, isn't it? All right, that $3 times 800, there's my $2,400 cash. The treasury stock has to come out how it went in. How many shares did I have left over? Well, if I purchased 1,600 and I sold 500, I had 1,100 shares, right? And then I sold 800 shares of these at $7. So 800 times 7 is 5,600. So there's my 5,600 that is coming out. That's how it went in. There's my 2,400. I know I've got a loss of how much? $3,200. But I can only reduce this paid in capital treasury stock down to 0. Why is that 2,200? That can't be. That's wrong. Oh, it says, assume the balancing paid in capital from treasury stock on December 20th is 2,200. I don't know why they do that, but what they're saying is you got a $3,200 loss, but you can't have a debit balance in paid in capital from treasury stock transactions. So they're saying it's not 1,500. They're saying the balance is 20. I don't know why they do that. It's confusing. But anyway, regardless, if you got a $2,200 credit balance, you can only make that go down to 0. So there's the 2,200. The rest of that has to be booked against retained earnings, which is basically a loss, isn't it? As if you had booked it from the income statement. All right. How will Bargain Central Furniture report treasury stock on its balance sheet We report treasury stock beneath retained earnings on the balance sheet as a reduction to stockholders' equity. All right. Okay, so that was treasury stock. So that leaves the self-assessment. Again, let me make sure that is sharing. Only one. All right, so this looks like a stock dividend. All right, so this is a small stock dividend, 5%. Remember that 20 to 25% threshold I talked about? If it's above that, it's a large dividend, and you want to use par value to calculate the dollar reduction in retained earnings. Here is a 5%, so it's a small dividend. So in this case, you're going to use market value of the stock. And so it says here that, pull this up, a 5% stock dividend based on 27,000 shares issued and outstanding. So 27,000 times 5% times the market value, which is $22, right there it is, gives me $29,700. Common stock dividend distributable is based on par. So $15 times that 27,000 shares times 5% is 20,250. And then the difference goes to paid in capital in excess of par. Then when I actually distribute the stock, I've reduced that common stock dividend distributable to 0 and put it into common stock at par. Let me show you the solution up here. $22 times 27,000 times 5%, 29.7. There's the $15 per share at par times 27,000 shares times 5%, right? And then there's the paid in capital, requirement 1. All right, what else is going on here? I see a treasury stock. This must be a comprehensive problem. All right, so then we purchased 2,000 shares of treasury stock at $22. So 2 times 22,000, 44,000. So that's a reduction. That's a contra account to my equity, which is a reduction of my total equity. And then it says I declared a 25-cent per share dividend. So in order to calculate that, I've got to figure out how many shares are outstanding, don't I? So I started with 27,000, right? Then we had 5% of 27,000. What was that? 5% of 27,000 is going to be an increase. Calculator, 5% of 27,000. That's 1,350 shares. So 1,350 shares plus 27,000 shares minus 2,000 treasury shares is going to give me my outstanding, right? The answer is yes. So let me show you the work solution since I'm sure it's on there. Common stock dividend share total 27,000 shares times 5% is 1,350. Dividends payable, there it is, 27,000 plus there's the 1,350 minus the 2,000 I was just talking about. That's what's outstanding. What is that? 28,350 minus 2. What is it? 26,350 times 25 cents. There's my 65.88 dividends payable. All right, and then they want you to do the retained earnings section. Retained earnings started out at 157,000. That was given. My net income for the year was 85,000. That's somewhere up there. There it is. Net income is 85,000. There's my dividends declared. You know, that's a reduction of retained earnings. There's my stock dividends, 29,700 declared. Not been distributed, it's just been declared. All right, and then what does my balance sheet look like for my equity? 150,000 shares authorized. There's my 26,350 outstanding. There's what's been issued. The 28,350 versus 26,350 is the 2,000 shares of treasury stock. All right, there's my 405 plus whatever that journal entry was up there for the stock dividend, right? Paid in capital as well. There's my retained earnings we just calculated. And there's my 44,000. So that's a good exercise. Kind of pulls everything together, doesn't it? All right. So that's chapter 12 and chapter 13. I hope you get some value out of this. You'll have to let me know. Try to do that maybe on some of the other chapters as well. So I'll get that out there here shortly.